the hidden death taxes. One of the hidden death taxes is income tax. That really is a death tax. You might say, Jim, what are you talking about? Well, what I'm talking about is, first of all, we have to define income. Income is defined as your gross income, which is all income from whatever source, wherever derived. So compensation for services. If you are inheriting from somebody and they happen to die in November, let's say, you see some money in a bank and you go, wow, that's my inheritance. I get to keep that. Well, that person who died, if they're working, they have to file an income tax return. So you need to just mentally get around, if they have not paid sufficient quarterlies, or you might still owe quarterlies, right? It's very important to pay attention that just because money's sitting in a cash account does not mean that there's not a tax bill. So you still have to finish out the last income tax return from the decedent. If you're watching this on YouTube, please subscribe to our YouTube channel. We really appreciate it. Please post questions, comments. I personally answer those questions and comments on our YouTube page. So go ahead. I really encourage you to post away. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've been an attorney for 30 years. I am a certified specialist in estate planning, trust, and probate law. I'm a real estate broker, securities, and insurance license, and a pilot single engine land. I'm also on a state bar committee that recertifies certified specialists, and I am currently working on the questions that will go on the certified specialist exam here just in a few days. The state bar will send those out and get comments. So I'm involved in the certification process. Kind of cool stuff. These are the lawyers in our firm. We are dedicated to all things, peaceful transfer of wealth from one generation to the next while minimizing taxes, which means we handle real estate matters, trust administration, corporate matters. Typically, it's for families with a real estate portfolio or some type of family-owned business. This is a disclaimer, super important. I'm a lawyer. I'm talking. Please don't listen to this and just say, "Oh, Jim said," and I'm going to go do this stuff because I said. You really need legal advice. And as we go through this, you're going to see you need some accountancy advice as well. But a lot of legal advice on a lot of the things we're talking about here, how to avoid these, really does require savvy, expert legal advice. So what are the hidden death taxes? One of the hidden death taxes is income tax. That really is a death tax. You might say, Jim, what are you talking about? Well, what I'm talking about is, first of all, we have to define income. Income is defined as your gross income, which is all income from whatever source, wherever derived. So compensation for services. If you are inheriting from somebody and they happen to die in November, let's say, you see some money in a bank and you go, wow, that's my inheritance. I get to keep that. Well, that person who died, if they're working, they have to file an income tax return. So you need to just mentally get around, if they have not paid sufficient quarterlies, or you might still owe quarterlies, right? It's very important to pay attention that just because money's sitting in a cash account does not mean that there's not a tax bill. So you still have to finish out the last income tax return from the decedent. Business income, gains on dealing with property, that's capital gains tax. We'll talk about that. The big is interest, rents, royalties, dividends, annuities. We'll talk about that. Annuities, very important, and life insurance proceeds. That's if the premium's not if the premium is deducted. So life insurance passes tax-free, but if you have a business and you say, gee, I'd like to buy some insurance to cover obligations if I die, and you die and you've been deducting those premiums, then that death benefit is deductible. So if you don't want that death benefit is taxable. If you don't want that death benefit taxable, you should not be deducting those premiums. Again, talk to your CPA, talk to the person who does your tax return. Pensions, discharge or forgiveness of debt for you attorneys out there. If you say in an estate plan that if you don't carve out a note being distributed to an individual beneficiary, even though you're distributing a note in the residue, that could be considered extinguishment of death. So it's very important. So whenever we are distributing a note, we want to make sure that that's included as a specific gift in the estate plan, and certainly if it's a child, rather than in the residue. So if you've lent a child $100,000 and it's in your estate plan to say, I distribute everything equally to my children, including this note, then that could be considered taxable as income. So a little bit of a gotcha there, even though there's no money to pay. So again, if you're a lawyer, think about this. If you're not a lawyer and you've done an estate plan, and if you lent money to kids and it's time, and you're thinking, I want to distribute that note to the kids, just has to be done artfully to avoid that tax trap. Income from an estate or trust. Estates or trusts do have income, right? If there's a trust or estate that's open for a year, it's going to have income. You're going to have to pay money. So income tax is a form of a death tax. And what we're going to talk about is the acceleration component with this income in respect of a decedent. That's a real important one. And the tax on income is a percentage. So the more you make, the more you pay. Most common income tax traps we see: IRAs, we're going to talk about that, annuity, life insurance if you're deducting the premium, or the installment sale. Okay, we're going to tackle each one of these individually. Income, much of what a person inherits, just before we get in there, much of what a person inherits, if it's a family home, if it's a real property, also known as real estate, a death benefit on life insurance if you're not deducting the premiums, cash, stocks, bonds, mutual funds. Broadly speaking, those are not taxable as income. Things that are typically taxed as income or income tax to the recipient are IRAs and 401ks that are not a Roth. So newsflash, that IRA you have, that $1 million IRA, when somebody inherits that, at some point they're going to have to take the money out. And in California, it's going to be over 50% tax if it's taxed at the highest rates. Gains on annuities. So if you put $100,000 in and the annuity is worth $500,000, that $400,000 gain is taxable as income typically in 1 year. We're going to talk about a way around that. Income of a decedent during the calendar year of death. So somebody's worked. Again, I mentioned this before. Somebody's worked and they may die in November. You're going to have to file an income tax return for all that money earned during that year. So that's going to be not that money that was income that was deposited in maybe an account. You're going to have to pay tax on that. Dividends and interest income, pretty obvious. And then the installment sale. So we're going to talk about what that is and why that's a bad thing. So inheriting an IRA and taxes. So let's say Abel dies in 2025. Now, Abel has a fairly large estate. Abel's got $10 million in stocks, a $4 million house, and a $1 million non-Roth IRA. Abel leaves everything to Baker. Well, in 2025, basically 14 million passes tax-free. $1 million is taxed at 40%, or about $400,000. So I just want you to think about this. $15 million estate, it pays a $400,000 in estate taxes. That $400,000, you can look at it several different ways. You're avoiding capital gains tax. If it's done right and all of this is included in Abel's estate, you're getting an adjusted cost basis. So that's a savings of up to over $5 million in capital gains tax. In California, it's 37.1%. 20% long-term capital gain plus 3.8% net investment income tax plus 13.3% state income tax. It could be potentially higher if you have recapture depreciation at 25% instead of the federal 20%. But the idea here is this IRA not only is subject to 54.1% income tax, it is also effectively subject to a 40% death tax. That is 94.1%. So if you have a large estate and you have an IRA, you need to understand that your IRA is taxable both in your estate and subject to income tax. Now, you do get a little bit of a deduction for estate taxes paid, and I'm going to walk you through that. It's pretty complicated, and I think a lot of people don't actually end up doing it because it's kind of like going to Europe and buying something and trying to get your VAT back. Look, I've been to Europe. I've tried to do that. It doesn't seem to work out, and it's like, I'm just leaving, whatever. So you think you're saving money when you're shopping in Europe, but it's kind of hard to get that money back. It's kind of like that with inheriting an IRA. So if Abel timely converts an IRA to a Roth, pays the $541,000 in income tax, the estate saves $400,000 in federal estate tax. Very important. If you have a large estate, the takeaway from here, if you have a taxable estate, so if your assets, if you're an individual, they're over 14 million or over 28 million as a couple, and you have not converted your IRAs to Roths, take a look at that, because the conversion to a Roth effectively can save your family a lot of death taxes. So that is just kind of a thing that to put away in your memory banks there. Don't forget that Roth conversion if you have a taxable estate. So 95%, does this sound familiar? It's a song. I won't sing it because YouTube will flag it. We can't put the clip on here. Let me tell you how it will be. There's 1 for you, 19 for me. Meaning you get to keep 5%, 95% goes to the government because I'm the tax man. Should 5% appear too small, be thankful I don't take it all. That is IRAs. So this tax man was written for IRAs in the United States. If you're wealthy and your kids, let's say, go to inherit that IRA, potentially a 95% in tax. So looking at this another way, Baker inherits this $1 million IRA, $370,000 in federal income tax, 3.8% net investment income tax, 13.3% California tax, and 40% federal estate tax, for a total potential of $941,000 tax on $1 million. Now, can you deduct estate taxes on your RMDs from IRAs? Yes, it's hard. What on earth am I talking about? When somebody inherits an IRA, They have to take that money out. They're either going to not have to take anything out for 10 years. They might have to start taking money out the year after the person who owns the IRA passes away. It depends on if that person who owns the IRA has started their RMDs or not. If you have not started your RMDs, your heirs don't have to take that money out for 10 years. If you have started your RMDs, they have to take it out. It's kind of the high level rule. I'm not talking about eligible designated beneficiaries, which is chronically ill and disabled beneficiaries. They always are going to have to take that minimum distribution. Internal Revenue Code Section 691C allows a deduction for estate taxes paid on what is called income in respect of a decedent. So IRAs are what are considered income in respect of a decedent. I don't want to get too in the weeds on this, but I'm trying to save you money. If there is estate tax paid and you inherited an IRA and you are taking RMDs, you might be missing out on a pretty significant income tax deduction is where I'm going with this. So this offsets the double taxation. It's what I talked about, that 40% death tax, 54.1% income tax. That is by definition double taxation, but there's a deduction for the proportion that is related to your RMD. So let's make this really simple. I know I'm slightly changing the numbers, but this is to understand the concept. If a person has a $10 million estate and $1 million was IRA, and the death taxes are $2.6 million, $260,000 is allocated to that IRA. So in the previous example, I said that if you have a $14 million estate and then you have another million, that IRA is effectively taxed at 40% because it's in your estate. If that IRA weren't in your estate, you wouldn't pay any estate tax, right? You wouldn't pay any income tax. So what we're talking about here is if you've already inherited this IRA and you're like, oh man, this tax thing is a real drag. If you've already inherited the IRA in our example here, you can basically take a 26% income tax deduction is how the math works out. So it's proportional. If your IRA that you inherited is $1 million and the tax was $2.6 million and your IRA was 1/10 of the estate, that means you have a $260,000 effectively income tax deduction that you can take. So if your RMD, let's say you've inherited this IRA, you have to take out $50,000 in a year, there's $1 million in the IRA, you would get, under this example, a deduction of essentially $260,000 divided by 20, which is 5% of the $1 million IRA, which is $13,000. So when the $50,000 RMDs reported on your 1040, you're eligible for a $13,000 deduction. That's if you itemize your deductions, right? I mean, there's a whole bunch of stuff that goes in here. So basically, what do you have to do to claim this deduction? So where I'm going with this is you've already inherited the IRA. How do you pay less income tax? You report the RMD as income on your Form 1040 line 4B. You deduct the estate taxes on the required minimum distribution. It is not subject, it's other itemized deductions. Again, if you don't itemize your deductions, you're going to lose this. But you do have to get to the Form 706, which is the federal estate tax return from the executor, the estate tax breakdown for the IRA, and keep your calculation records for IRS inquiries for up to 10 years or more. A lot of work. I will tell you, this is where a lot of law firms absolutely fall down when it comes to trust administration. In our firm, we do a very complete trust administration. We give each beneficiary, this is if the trustee hires us to do this, which we recommend, we give each beneficiary a binder that has all this stuff in it, right? So if a beneficiary is inheriting an IRA, they're going to have all this information in there so that they can pick up that deduction. And that's a $13,000 deduction for that RMD. And the maximum income tax deduction is $260. But that's, in California, it's worth $100,000, $130,000. So a little bit of a benefit there. So how can you protect an IRA? So one of the other things that I would say a tax on an income tax on IRAs or a tax on IRAs is absolutely no planning. So somebody inherits an IRA and then gets a divorce. Is that going to be subject to a 50-50 division of community property? I have no idea. It might not. It's inherited, but what you do with your inheritance after you receive it, you can certainly transmute that to separate property. So what we do for a lot of our clients who have the larger IRAs, maybe $1 million IRA, we put a wrapper effectively around that IRA, which is the IRA Legacy Trust. I cover this in my book, Savvy Estate Planning, What You Need to Know Before You Hire the Right Lawyer. The link is in the notes. We go kind of in depth on asset protection for beneficiaries, protecting it from divorce, protecting it from creditors and predators. And what this is this is an IRA. Instead of going to the beneficiary, so Abel's IRA went to Baker. Instead of it going to Baker, it is Abel's IRA trust for the benefit of Baker, right? So it goes into a special IRA Legacy Trust. This is something that must be set up by Abel, right? It has to be set up by the owner of the IRA account, not the beneficiary after you inherit it, but it's set up by the owner of the account. And one advantage is you can name a third-party trustee and you can direct the trustee, hey, trustee, I want you to take care of all the paperwork. I want you to get that 706. I want you to calculate my deduction. And oh, by the way, for money that stays in that IRA trust, if it happens to be in Nevada and it's not distributed to you, it is not yet subject to California income tax. So you're getting a bit of a benefit there. Really take a look at that. We cover that in our book. Let's look at annuities. Charlie invests $100,000 in an annuity in 1990. When Charlie dies, the annuity's grown to $600,000. So it's gone up $500,000. This is fantastic. Charlie's not married and names Delta as beneficiary of the annuity. The year Charlie dies, the $500,000 is taxable as income to Delta. That's it. Delta's going to add $500,000 to her income that year, pushes her income way up, pushes her safe harbor. So the following year when she makes estimated payments or maybe makes an adjustment on her W-2, she's got to add, she's got to, reduce withholdings, right? So her paycheck may be less if she's working. But the year Charlie dies, that $500,000 is taxable. Charlie can, and we've covered this in other webinars, can do some planning before that happens. So if you have an annuity that's gone up quite a bit and you're not leaving it to a spouse, so there's some different rules about spouses. This annuity, so Charlie could have set it up so that Delta could take that $500,000 gain over Delta's life, which might be 30 years. So it's, 100, not that much money, 15,000, whatever the math works out over 30 years. So she could stretch that taxable payment coming out. So the year that Charlie dies, maybe 15,000 comes out, but 485,000 stays in and is working for Delta. And instead of Delta paying that money out in tax, paying that 250,000 in tax or 300,000 in tax, that money's working for Delta over the years. And when you model this out, if Charlie can rework his annuity, and this is what we do with a lot of clients, rework the annuity so that when Charlie dies, the payments to Delta are spread out over time. It really reduces, it creates a lot more intergenerational wealth is where I'm going with that, right? Might not actually reduce the tax bill, but might end up with more money in Delta's pocket over time. Life insurance and income tax. Life insurance is normally free from income tax unless you deduct the premium. So if you're a business owner and you pay $1,000 a year for $1 million premium, you're a young person, and you're deducting that $1,000, not that big of a benefit, that $1 million is going to be taxable as income. So really pay attention to that. And this is serious stuff because there's an IRS Form 712 that's issued. That life insurance not only is includable in your estate, and the IRS does report it, or the insurance companies report it to the IRS, that not only is included in your estate, but again, if it's subject to income tax, it could be potentially a double whammy. So Wanda buys life insurance with $1 million death benefit. Wanda dies. The $1 million death benefit is subject to 40% tax, death tax, but not income tax if Wanda hasn't deducted the premium. So there are ways that we can keep that life insurance benefit outside of Wanda's estate, and that's through an irrevocable life insurance trust that we cover in other webinars. The income tax in respect of a decedent and the installment sale. So clients will come to us and they'll say, Jim, I'm trying to figure out ways to minimize tax. And we do cover this in other webinars, the installment sale. So instead of, and the example here is a great example. Echo buys a home in 1974 for $100,000. Echo sells that property in 2024, right, 50 years later for $1.1 million. But Echo structures the deal as an installment sale. So what does that mean? So over a 10-year term, Echo is realizing this $100,000 capital gain instead of the $1 million capital gain, instead of in 1 year, recognizing that over 10 years. Now, the benefit is you're going to pay significantly less capital gains tax, okay? Assuming Echo doesn't have much other income. The idea is to slowly get paid this $100,000 over 10 years. The problem is if Echo dies before it's paid, all of those remaining payments, $900,000 in capital gain, are accelerated into 1 year under Internal Revenue Code Section 453B2. That's up to a $334,000 tax bill. But here's the kicker. Echo sold that property, does not have the money, has a right to collect money, but is only getting $100,000 a year. So the estate's going to have to come up with money to pay, right, the tax associated with those future payments. So installment sales can be tricky. I would say if you're watching this video because you've Googled installment sale, income in respect of a decedent, what can I do? it can be a very difficult place for many people to be in, especially if there's not liquidity in the estate, because those taxes are due 9 months after death. Okay. State inheritance tax and death taxes. So state inheritance tax, what are we talking about here? We are talking about the hidden tax that certain states impose. So the federal government imposes federal death tax at 40% in 2025. The state death tax is levied on the total value of a deceased person's estate before it's distributed to the heirs if they are a resident of that state. Okay, so it's paid by the estate rather than the individual. If the inheritance tax is paid by the individual, and we'll cover that in a couple of slides. States with the state taxes often have a threshold amount, meaning we're not going to tax anything under $1 million, which is Oregon, but Oregon taxes everything over $1 million at up to 16%. Washington, they say we don't tax anything. It's a little over $2 million, but everything over that is taxed at 20%. So these are not small numbers. So you may be in this weird spot where you may have a $5 million estate and you're not paying any federal estate tax. But if you're an Oregon resident or a Washington resident, your estate will be paying death tax, even though they'll pay state death tax, even though there's no federal death tax. And oh, by the way, there's a gotcha. If you're a California resident and you own a vacation home in Oregon, that is included and is subject to Oregon's inheritance tax as well. And if you're also thinking about retiring in California or Washington, or Oregon or Washington from California, bear in mind, they're going to have a estate or death tax. They might be great places to live in retirement, but you don't want to die a resident of those jurisdictions. And there are some ways around, if you have commercial property in Oregon, you can set up an LLC and turn it into an intangible. You just can't do that with personal use assets. And I would say that's broadly speaking the rule in many of these jurisdictions. There's a way around it if you're not a resident of that state. States with the state taxes, they have the threshold and the rates are progressive, meaning the more you have, the higher it goes. States with state, estate, or death taxes are Connecticut, DC, Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New York, Oregon, Rhode Island, Vermont, and Washington are the states with the state death tax. The state inheritance tax is a tax imposed on individuals who inherit assets from a deceased person who are resident of that state. So the tax rate depends on the relationship many times. So sometimes it's exempt. If it's a certain dollar amount between parents and children, it's exempt. So these would be direct relatives. If it's remote relatives, it's a little bit more. Not all states impose an inheritance tax. And there are 5 remaining states with inheritance taxes: Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. And these are, Maryland's a flat 10%. Maryland also has an inheritance tax and a death tax. So if you die a resident of Maryland and your children are in Maryland, and you're not only paying federal estate tax potentially, but state inheritance and death tax. So they tax you even more than California, shocker. But again, the rates depend, and it's a graduated system. So the key difference between the two taxes: inheritance tax is paid by the individual inheriting the assets. Estate tax is paid by the estate before distribution to the heirs. Estate inheritance tax rates vary based on the relationship. Estate tax rates depend on the value of the estate. So inheritance is looking at relationships. Estate tax typically does not. That's taxed on the decedent level. Inheritance tax is taxed on the recipient or the beneficiary level. And many states don't have any. California doesn't have any. Just don't tell anyone. Don't tell anyone in Sacramento that we don't have an inheritance tax. We got plenty of other taxes that kick in when you die, but not those. So increased property tax and loss of Prop 13 is a hidden death tax. Now, you may say, Jim, how can property tax be death tax?